Welcome back for the third and final session of the day. Thanks for sticking with us. As I said before, we covered really the five Greeks that you are most predominantly going to be confronted with and use delta, gamma, vega, theta, rho. Got into some detail there, quizzed the audience, made you think about it throughout. This presentation is going to be a little bit lighter, so it won't be as challenging for you. And we certainly have time for questions. If anyone in the audience has questions along the way, we'll be able to field those for you, no problem with this session. For those of you online, thanks for joining us as well. And if you have questions as you go through online, feel free to make good use of the Q&A box. We do have a team online behind the scenes answering questions. That is the OCC Investor Services team. Mark Benzaquin and his guys are online right now answering your questions. My name is Ed Modl. I'm the Director of Retail Education at the Options Industry Council. I got my start in the business in the late 1990s on the trading floors as a professional options market maker. Did that for a number of years. I often say I really wish I was born about 10 years before I was. And I got down to the trading floor a little bit earlier than I did because it wasn't too long after the turn of the century where the trading floor somewhat disappeared rather quickly. I knew that was going to happen, and I wanted to get down there and have that experience in the pits with the colorful coats and the shouting and screaming and fighting with people. I wanted to have that experience before it disappeared. I went from yelling at people in the pits to yelling at my computer screen. I went to the electronic environment. That was a fun transition for me. I also went into the brokerage business for a little while. Fun story there. As I was making the shift, I always thought I was going to work with investors and be on the service side of the business. And in 2011, I decided it was finally time to make it happen. I thought trading was going to be a part of my career, and it lasted many more years than I expected. It just took me over for quite a while. In 2011, I proactively went and got my Series 3 license to be a futures broker, and I called the biggest and best company in the world where you can be a broker, and that was MF Global. Who knows that name, MF Global? Not too many names. So
Thanks, Ed. I'm going to put him on the spot real quick. Ladies and gentlemen, this guy is sick. He's been sick today. He's traveling. He's not feeling well. He was drinking the water earlier. That's so he wouldn't cough. So this dude is really powering through today. Give him a little hand, man. I mean, this dude's doing his job. He's doing his job. He's doing a great job. The other thing, too, to add on to what he was saying as far as volatility, the firm that I worked at, it was called Peak Six Investments in Chicago. And similar to what he said, we traded volatility. That's kind of the way that they chose to go about market making and make money. They were volatility traders. Volatility. So immediately it begs the question, oh, volatility is high, you just sell it. Well, not necessarily always. You do take a lot of other things into account. At least you try to. Just because every volatility is high doesn't mean you always go and sell it. Just because every volatility is low doesn't mean you always go and buy it. Doesn't mean it's going to bounce back and go higher. There are a lot of different inputs that you always have to look at when you're trading volatility, and you have to anticipate. So there's a lot to it. I mean, it's just a really fascinating way to trade. But when you're doing it, you're looking at so many different inputs based on, sometimes some people will look at how the stock is trading for what different reasons. Some people will look at those volatility charts, which is one of the bigger ways you determine it. One of the ways you go back and look at how implied volatility was in the past is a volatility chart. And you'll have volatility charts for different terms, whether it's a 10-day or 30-day volatility or 100-day volatility if you're trading leaps even further out. So there's a lot of different inputs, a lot of things to look at, a lot of information. But you guys will get it, I think. You guys probably already have it. So looking at option symbology. So in 2010, the options industry created a much simpler standard symbology for looking at options and looking at your option chain. So you'll have XYZ stock. You'll have the year of that option, or when it expires. You'll have the date. And then you'll have the strike. And then you'll also have the month or type of option. Okay? So it's funny because I started in 2006. And the great thing about these guys, they throw slides together. They make my life easy, honestly. When I came in, this type of thing was still around, but it was starting to change a little bit. But looking at option strikes and option, like for specific options, it was a lot more confusing. I mean, you'd have, a ticker, and then you'd have another letter combination go along with that specific option, and then that specific call and strike, and it was just a lot more complicated. So like something looking at this, he and I were talking. Honestly, I barely remember this. With the idea of looking at a specific month and then looking at A through L was calls and M through X was puts. I mean, this was a lot different than the way that it used to be, but this is how it used to be. And so when you were specifically looking at, an August call for a specific option, you'd have the ticker, and then you'd also have the small other usually three-letter ticker along with the option, which could get confusing sometimes. If you had like a NASDAQ name, like a four-letter NASDAQ name, it would also have a three-letter ticker. So sometimes it could, unless you just kind of knew. Of course, after a while, a lot of things happen that way. When you're in the option trading industry, you see these things day in and day out. You eventually kind of just knew and you figure it out. But it was a lot more different than it is now. So also with flex options usually, with flex options, they're very customizable. You can choose a specific expiration and strike out to where you want to create an option. Usually people will contact the exchange to do this type of thing. Usually you'll see this with institutional trades for flex options. They're non-standard, customizable up to 15 years, and it allows you the negotiation of exercise style, expiration, and strike. And so a lot of times people will contact the exchange. Market makers will create a flex option out for traders to trade. Usually you'll see this, like I said, with larger institutional companies where they have exposure in certain areas and they want to protect themselves using options. Like we've said earlier, options allow you the ability to protect your risk. And so a lot of times you'll see this with the flex options. So example, XYZ, 1XYZ or 4XYZYX, depending on those tickers, it gives you an idea of how you would go further out and look for an option that you could exercise. That you could use to hedge. So with equity and ETF flex options, all equity ETF flex options are PM settled. That means settled after the close, settled to the price of the closing index or ETF. And their numeric refers to the exercise style only. So like Ed had said earlier, American exercise, you'll usually see that with all equity and ETF options. Those are different as opposed to the European exercise where you can't exercise though prior to expiration. American exercise, you can exercise prior to expiration. You'll see that play out sometimes with dividends and via call options. Index flex options, you have one for American exercise for AM settlement. Those are options that settle to the morning price of the index. They'll usually cease trading the day before, and then the index will, where the index opens at in the morning, that's where those options will settle to. 2 for European exercise AM settlement, and then 3 for American exercise PM settlement, and then 4 for European exercise for PM settlement. And then expiration cycles. So usually expiration cycles for different options are released at different times. When the listed options market began, all equity option classes were assigned into 3 cycles. You have the quarterly cycles, which is the January cycle 1, which has January options, April options, July, and October. Then you have the February cycle, cycle 2, which is February, May, August, and November. And then finally, you have the March cycle, which is cycle 3, which is March, June, September, and December. So the 2 nearest term consecutive calendar months will be listed usually, and then the next 2 further term quarterly cycle months after that. More frequently traded securities list many, but many of those more expirations are determined by the exchange usually. So let's look at an example where you have XYZ stock. It's a cycle 2 option, meaning it's February cycle, and it's now December. So which months would be available to be traded, or which ones are going to come up and added next? So if you have that February cycle and it's currently December, the 2 near-term months are December and January, and then the next 2 further term months are going to be February and May. And then after December expires, so once December rolls off, August would be added, and you'll see the August options listed. So what are option chains? They're an array of information detailing all options available to be traded in any given security. They'll usually kind of tell you, in addition to the available strikes, the chains can sort of detail the bid and ask and the market size, the volume, and the open interest, and the implied vol in the Greek. So in that, when we were talking about earlier, where you can go and look up the option chains, you'll see this type of thing. You'll see the available strikes, you'll see those option chains, you'll see the calls and puts, you'll see the bid and ask on those. You'll see the market size in that. You'll see the market on those options, and then you'll also see the size available to be traded in any one of those options, whether it's call or put. You'll see the volume that has traded, and then you'll see open interest. So how many people have interest or options that are on that strike? You'll also see the implied volatility attached to those options, and then you'll see the Greeks along with those. Where can you find them? You can find them on any one of your online trading sites, brokerage platforms, like we said, the OIC quotes page that we listed off earlier on the optionseducation.org site. So you'll find those in all those different places. So if we're looking at an example here, and I was talking with the young lady earlier about how to kind of read this. You have stock XYZ. As soon as you plug that in, you'll get the stock information off top, right? You'll see where the stock is trading. You'll see the change in the stock, 52-week high and low, and the specific dates where that happened. You'll see the stock volume. You'll see the average options volume that trades, and you'll see the average open interest, okay? And then if we're looking at a specific expiration, in this case, we're looking at standard DEES expiration. You'll see the call and put for the 3. So we're looking at, around at the money, we're looking at the 311 strike. You'll see the bid and ask on those. It also gives you the mean with that. You'll see the change on that specific day. So stock went down. You can see that the calls went down in value and the puts went up in value. These are always good ways to just test your options theory. You'll see the volume that is traded. You'll see the open interest. So a lot of times there are plenty of traders who trade off of open interest. They'll look and see where's the strike that is most interest, where there's a lot of people have. It doesn't necessarily mean, it's not an indication of what's going to happen in the stock. If you're looking to buy calls and you look at an open interest of calls and you're like, oh, there's a lot of calls on this strike, I'm going to buy this strike. Stock went down. Why did it go down? That's not really a way to look at it. It gives you an idea to gauge that interest. Professional traders will say, okay, there's a lot of calls on this strike. I'm going to buy. If for some reason, and I feel this is a volatile stock and it's going to move up big, and when it does, there's going to be people coming out there to buy their short calls back, and they're going to bid that volatility up. Now, that's how professional traders look at it. You can kind of look at it in that same type of way, but open interest just gives you an idea of how much is going on in that strike. Yes, sir?
Isn't there a correlation with the higher the open interest is, the more narrow the spread is between the bid and the ask, which would give you
I'd just say that's a generalization. It just really depends on the stock. I mean, you wouldn't say that in certain large cap stocks because they already have a narrow bid and ask probably anyway. So it just depends. It really depends. I would say that's probably a generalization depending on the specific stock, but that's not a hard and fast rule. For the most part, the best thing you can do with open interest is just look at and see this is where a lot of people are trading on this strike. At least maybe I'll have a good ability to get out of my option any given way because there's so many people who have options on that strike. So that's kind of how people view it. You have your implied volatilities there, and then you also have your Greeks that we've been discussing all day. So, and this is another way to look at it. This is you should pull these up often. Anytime you're looking at your specific stocks, your specific options, these are ways to test your options theory. I have these calls. If I buy these calls, what's my delta going to be? Delta's positive. What's my gamma going to be? What's my theta if I buy these? And you can just keep it from any one angle. Or if I sell these, I'm short. What are these inputs going to be now, right? And so I'd say this is a really good way to look at how you're analyzing your Greeks. One that's up there that we didn't discuss today, and I just kind of saw this too, alpha. It's a ratio of, I think it was like a ratio of gamma and theta or something like that. I'd never seen that. So this is specifically what they do on the site. So that's not something where you guys are going to go back and, hey, they didn't discuss alpha with us. Well, it's a ratio that they've come up with, and that you can look at the ratio and figure out why that makes sense. It may be relevant to you. It's not a standard Greek, is what I'm trying to get at.
They're all negative. I mean, a lot of your alphas are negative for some reason. So it just depends.
Could be theta to vega or something like that. I'm not exactly sure. Why don't we just pull it on? Oh, I can't do it on here. She had it earlier. But it's a ratio that it's looking at. So it's a new one for me. I'd never seen that one, but it's not a standard Greek. It's a ratio that they've come up with on the website, and that's why it's there. I jumped ahead of the slides. I went through these for you. So another thing to understand is order types. These are these sort of emanate from the idea of what you similar to do with stock, but a little more in detail with options. So when you're trading an option, in general, if you're buying an option, you have no position initially, then you're buying to open an option, okay? If you have a short option that you have already on, that you already have an existing position, when you buy to close, that's what you're doing when you're closing that position. You buy a short option to close. A lot of times you'll hear people say that's covering a position. Sell to open is a situation where you don't have a position previously and you sell an option on that strike. You are selling to open. And then finally, sell to close. You have a long option already. You're selling it out. You're selling to close. Some traders will refer to that as busting a position or closing that position out when you're long it and you're selling it to close. So those are the different order types that you'll often see when you're executing. You should understand those too. Those are kind of weird. If you haven't traded options before and you're first pulling up an option trade and you're like, okay, I'm going to buy. And then you see buy to close, and you're like, well, what am I doing here? Just understand, buy to open is initiating a position that you didn't have a position on that line before. And then there's a market order. So a market order is the biggest thing about a market order, I would say, is that when you want to get something, when you want to get a stock or you want to get an option, you put in a market order. That means you want to trade it right immediately. So it's usually right where the option is trading. You place a market order to immediately buy or sell whatever, at that current price, right there where the market is. That's a market order. Limit order is when you're a little more selective and you want a specific price. So if you're trading and you're like, okay, let's say the market on these calls is 386 at 391. And you're like, I want to buy these calls for 387. Now that's a little bit off the bid. If you put it in, if you get frustrated right away and wonder why you don't get that price, well, that's kind of the bid. Somebody doesn't necessarily want to sell that. Somebody has to sell that to you. And they may not necessarily want to sell that. They may want to sell 2 cents off the bid. The current bid is 386. They may want to sell 388, right? You never know. So just because you put a limit order in doesn't necessarily mean you're going to get hit, as we say. Doesn't necessarily mean it's going to trade. Typically, though, what happens is if you have that 387 bid in for those calls, most likely when you get hit or you end up buying those calls is when the stock drops. So that's kind of usually how that works. But limit orders are more specific when you're more specific about the price that you want to trade. Market orders are usually done at market. So like in the market order in this case, when we're looking at those same calls, 386, 391, if you put in a market order for 391, you're going to immediately buy those. And now to open interest for Ed. Close on out.